Well, moving forward, we're really splitting it into two parts. In the shorter term, we think a number of the major developed markets around the world, particularly an economy like the US, we're anticipating in the short term possibly quite a sharp economic recovery. And we really think that is due to the amount of monetary stimulus that's still sitting behind the US economy. We've seen the Federal Reserve in the United States undertake a massive quantitative easing program where they've effectively injected about $1 trillion into the US economy, but that money hasn't yet actually gone into the economy. It's actually gone into the banking system, and then the banks have put that back on deposit with the Federal Reserve. And we're anticipating that at some stage the banks will start to lend out that money that's been printed by the Fed, and we could see quite a sharp acceleration in the short term. And we think over the next 6 to 12 months, that is the most likely, it's not a certain outcome, but the most likely outcome. And we think a number of the other major developed nations, possibly in some nations in Europe, the UK, could see similar, rather sharp recoveries in the near term. But then looking out over the next 3 to 5 years, we're much, much more cautious. We think that that money, the stimulus, is going to come out of those economies. The economies will start to deleverage, again, is the most likely outcome. And we think we're then going to go into that period we've been talking about of a very subdued economic outlook in the developed nations around the world. So we're optimistic in the short term, but rather pessimistic or a very subdued outlook in the 3 to 5 year view. Look, we don't spend a lot of time forecasting what markets will do in the short term. What I've said in my investor letter is that we feel that financial Armageddon has passed. The scenario we were worried about in January and in February last year, there's been a very dramatic recovery in credit markets around the world, and we are really not concerned about a financial Armageddon scenario. So we feel very relaxed in investing at the moment, and we actually think in the areas in which we're investing, we still think there are enormous opportunities that are very attractively priced on a medium to long term basis. And that's notwithstanding that the markets have seen a very strong rally since March this year. What I can't tell you is whether markets will be lower than they are today in 6 months' time. I told you that we've got a positive economic outlook for the next 6 or 12 months. Then we think we're going to go into a much more difficult period moving forward for the next 3 to 5 years. When the market starts pricing those different scenarios, is very difficult to predict on a short-term basis. Well, in recent times, if I really start from March this year when markets recovered, we started in March with about 30% in cash, and the most significant thing we've done over that period is we ended December this year, or December 2009, with 4% cash. So we've made a significant move away from cash to be invested in the portfolio. We've maintained our portfolio weighting at about 50% in multinational consumer, what we would call staples and non-discretionary stocks that have at least 25% of their revenues from the major emerging markets. We still believe that is a very, very good place to be invested over the medium to long term and should perform very well even if we do see a more subdued economic outlook. So stocks we've invested in that period, Procter & Gamble, McDonald's, Yum Brands, and we've recently introduced a reasonably sizable position into Kraft during the bid for Cadbury, and we're very positive about that combination, notwithstanding that they paid a very full price for the Cadbury business. So we've maintained that weighting. The second thing we've done is we've increased our weighting to financials, and probably most importantly, early on in March, we significantly increased our weighting to American Express. We have a very positive view on the payments industry generally over the next 5 and 10 years, and we think American Express is very well positioned. It's actually performed very well, up 3 or 4 times since we invested in March. But since that, we've actually increased our weighting or exposure to a number of banks, and the most notable banks have been Wells Fargo and US Bank Corp. which again we think are very well positioned with a medium-term view. And then probably we've also increased our weighting to the internet sector, both Google and eBay. eBay in the payment sector with PayPal, and Google in the advertising sector. And there were some very, very good opportunities over the last 6 months to increase our exposures to those businesses. And eBay is actually our largest investment we had at 31 December. And as I mentioned, we are very positive regarding their PayPal e-commerce payments business, looking out 5 and 10 years. Yes, well, an infrastructure stock really hasn't been in our top 10 portfolio, and it really isn't a play on emerging markets. Why we're very attracted to Macquarie Infrastructure Group. First of all, we have an excellent infrastructure team led by Gerald Stack and Dennis Egar, and they're very, very familiar with Macquarie Infrastructure Group. It's actually splitting into two companies, or has just split into two companies last Friday. Intoll, which is an infrastructure company now that won't be managed by Macquarie and owns two of the very best infrastructure assets in the world. The 407 toll road in Canada, in Toronto, which is really an unregulated monopoly toll road asset with about 89 years to run on its concession deed, and has an ability to increase prices at its own discretion for the next 89 years, and in the view of our infrastructure team is probably the most attractive infrastructure asset in the world. And Intoll also owns the M7, or an interest in the M7 toll road here in Sydney, which is also a very attractive infrastructure asset. So that's going to be a pure play infrastructure company that we think is very attractively valued. And then it's splitting in the rump asset, which is of less interest to us. We'll own a number of other infrastructure assets around the world. So we're very optimistic on Macquarie Infrastructure Group, particularly Intoll, that's been split off, and we're very happy to have made that investment.